With so many big terms and concepts out there, the world of trading and investing can seem confusing if not daunting. Don't worry though, as we all had to start once, and by breaking down these terms and concepts one by one, it won't be long until you are well versed in the world of investing lingo. This time we're looking at leverage, looking at what it means and how traders use it to make profits. And let's start off with a definition of what leverage actually is. In terms of finance, leverage is an investment strategy using borrowed money to increase the potential of returns on investment, and that is from Investopedia. So what does this really mean? Well, to put it really simply, leverage is when traders borrow money to increase their potential for returns. Now that might sound a bit confusing on its own, but let's look at this and explain why traders do this. Well, there are many reasons why traders do this, but the main one is to increase the potential for profits. Because when using 10 times leverage, for example, a trader has the potential to make 10 times the profit they otherwise would. The appropriate use of leverage can make it much easier to make a huge profit. But not every side effect of leverage is beneficial, as by using leverage traders are exposed to more risk, and therefore it's easier to make bigger losses, and even completely blow out your account in an unbelievably quick amount of time. Some of you guys will already know what I mean, but I'll explain this further as we go on. Let's look at a real world example of this to make it all make sense. Let's say I have £1,000 in cash, but this can be any currency, dollars or anything else. But let's say I have 1,000 in cash, and I decide to use 10 times leverage on my next trade. Well, I now effectively have 10,000 in cash, 1k of my own money, and 9,000 provided by my trading platform, broker, bank, or whoever is giving me this money. Wherever I get it from, 1,000 is mine and 9 is from elsewhere, because I am using 10 times leverage. Let's say that I buy a stock and it rises by 10%. If I buy it with 100% of my equity of the 1k with no leverage, I make £100. If I buy it with 10 times leverage and 100% equity, and the stock still rises by 10%, I now make £1,000 instead of 100, but my risk is significantly increased, and here is why. Now let's say the same scenario as before, right? Let's say I'm using the 10 times leverage and the 1,000 in cash and 9k from the bank, for instance. Let's say that I want to buy the same stock or a different stock, and that now goes down by 10%. If I'm using 100% equity of my 1,000 invested, I only lose £100. Yes, that's not great, but obviously you see what I mean. Now let's say I'm using 10 times leverage and then I lose £1,000. So that means that I would have effectively blown out my entire account on one simple trade by just losing 10%, because I only had 1,000 and I had the potential to make the profits of 10k, but I also have the potential to make the same losses as 10k. And that's how very easy it is to knock your account out completely with leverage. So it is ultimately a risk. Yes, it's much easier to make money, but it's also significantly easier to lose money, especially at the higher rates of leverage, as you obviously are exposed to more risk. And this is why so many traders completely blow out their accounts whilst using leverage. Ultimately, the cost is increased volatility. You have the potential to make more, but you can lose money just as fast, and for a lot of people, when looking at trading psychology, the losses mean a lot more to them. For instance, if I only have 1k, that's all the money that I have, and then I get completely blown out, that's a big deal to me, and that's what a lot of people don't realize when they jump into the world of leverage. Sure, you can make profits a lot easier, but when it actually hits the fan and you make a loss, the same thing will be true, the same amount will be reflected depending on the percentage. It will ultimately be a heavier loss than what it would be using cash. So there you have it. Simply put, leverage is the process of borrowing capital to increase the potential for profits. And whilst it can increase profit margins, the absolute opposite is also true, and you can also lose a lot of money just as quickly if not properly planned out. But hopefully this was a good introduction into leverage and how it works, and why traders actually use it. So if you learned something from this short video, do make sure to share it with a friend and also like and subscribe. But that's it, so I hope to see you tomorrow in our next episode in the series, but that's it for now. Thank you so much, and I'll see you soon.